What up, everybody? We're going to start in about 10 minutes with Matt Maley, Chief Market Strategist at Miller Tabak Equity Firm. He's going to be with us, and we'll be starting in about 10 minutes, guys. So don't go anywhere. We'll be starting very soon. What up, everybody? Welcome to today's session. We have an amazing guest here lined up for you guys. Matt Maley, Chief Market Strategist at Miller Tabak Equity Firm, as seen on CNBC, Bloomberg, Yahoo Finance, everywhere else that you see him. Pretty popular around the block, I'd say. In the meantime, while we do get started here, guys, go ahead and drop in the chat where you guys are tuning in from. Let us know where you guys are checking us out. We always like to get a good idea of where the fan base is located, right? You guys are pretty spread out, and it's always interesting to see that as well, guys. So let us know in the chat where you guys are tuning in from, and we're gonna have Matt here pretty soon, guys, but I need to know if you're ready to start. So you also have to let me know in the chat if you're ready. If you're not ready, that's fine. We could just delay this. Just let me know in the chat if you're ready to get started. All right. It's totally up to you guys. All right. We have some people checking in here. G. Meyer, North Carolina, shout out. Spokane, nice. Tita from San Antonio, the Outer Bin from Oregon. Texas, are you in two places? Oh, San Antonio, Texas. Okay. London, Mr. Flusy, Germany. Jamir is ready. Bruno is from Croatia. I need to know where you're from and if you're ready. Those are the only two things I'm asking from you today, okay? And we're going to get started here really quick, guys. So let's see here when we can get... So, okay, Frank from Montreal. Tia is ready. All right, Tia, just because you said so. Just because you said so. So Tia's running the show here. And I think Mr. Maley is somewhere there in the background somewhere. I know he's going to give me the green light. Hey, Mark, how are you, man? I don't know if you can hear me, Mark. Can you hear me, Mac?
You see me, Rodrigo?
Yep. How's your audio? Can you hear me well?
Yeah, all set.
Okay, cool stuff, man. All right, Corbin, Croatia, Buenos Aires, Argentina. All right, Matt, you got quite a fan base here. Pretty spread out, pretty nice. How was your day today in the whole trading world, Matt?
You know, it was actually a pretty good day. I thought it was going to be a real boring one, and you know, volume was low. I mean, it's a couple of days before the long weekend, long holiday weekend, but we made some nice money on some QQQ, the Nasdaq 100 calls. We made some nice money on the Tesla calls, two different times, and we didn't play in the Microsoft, which I really wanted. Probably should have. I didn't say we missed one there, but this one we're looking at closely. But you know, it's obviously tomorrow's going to be kind of a quiet day with the long weekend coming up. But it's good. Next week, which is usually a rather quiet week between Christmas and New Year's, could have a lot of fireworks. So really looking forward to. You know, even if tomorrow's kind of a boring day, I think next week will be big, and the next year is going to be
right
a really great year for trading, I think.
And I remember that, well, last time we spoke, there were these QQQ calls that were up like, I don't know, like 300%, something like that. And then there were some puts that were up like 230, 250%. So you're saying that on top of those trades, you also got the Tesla trade, because we were talking about it yesterday. You specifically mentioned Tesla calls, specific levels, and they all hit.
Right, exactly. And to be honest with you, the QQQ calls that we talked about the last time, I said we had a call and a put. I'm talking about new ones we had today that we put on during the day that worked out quite well. And some other people, it's funny, even though it wasn't my suggestion, it was somebody else's suggestion on the chat room who profited in the TQQQ. That's the you know, the leveraged ETF, the 3 times leveraged ETF. And some people, I think, bought some calls on that one, which did even better. So these are on top of the trades we did late last week and early this week.
Yeah, that's great to see. I remember the Tesla call. I was in the Tesla trade that you said yesterday, and that's great. So, Matt, for those that are not familiar with your background experience on Wall Street, if you don't mind just giving us a brief background of, you know, your experience on Salomon Brothers, Merrill Lynch, all that stuff.
Yeah, just you know, as Rodrigo said, that I'm market strategist, I should say. I used to be what's called the equity strategist, but I follow so many other markets. We changed the name to market strategist because you really have to know what's going on, and whether it be the fixed income markets, other bond markets, currency markets, commodity markets, et cetera, because they all impact the stock market. But my background is in trading, and most strategists come from are analysts. Nothing wrong with that. They're former analysts or former economists. My background is on the trading side of things. And I was a trader at Solomon Brothers for 15 years and Merrill Lynch for 10. So 25 years on two of the biggest trading desks on Wall Street. Back in the 70s, 80s, and 90s, Solomon Brothers, if you're younger, you've probably never heard of it, but they're now part of Citigroup. They got bought out back in the 1990s. But back in those decades, they were the most important and most powerful trading desk on Wall Street. And I wasn't there in the 70s, but I was there for 15 years in the 80s and 90s. And then I moved to Merrill Lynch once they got taken over and spent almost 10 years there. And on those trading desks, I worked and I covering the trading desks of the biggest and most important customers, institutional investors in the world, whether it be the biggest mutual funds, hedge funds, BlackRock as hedge fund, Fidelity, Wellington, these huge mutual funds, insurance companies, banks, State Street Bank, et cetera, JP Morgan Asset Management. These are the types of things that we covered. And in those areas, I mean, we always want to know what's going on fundamentally and what's going to, move the market and move your investments on a long-term basis. But on a trading desk, you need to know intermediate and short-term as well, because you're trading around positions. You don't care where it's going to be 6 years from now. Your book is a short-term book, and you're just trying, several weeks out, in some cases, several hours, and you trade around that book. You need to know what is happening now and what is going to happen, not what should theoretically happen 10 years down the road. And we always talk about having, you always want to have that bucket, the long-term bucket, that you have stocks that you want to own for 3 or 5 or 10 years or even longer. And that's great. But those who really want to maximize the returns, it's, if you have that other bucket, it may be a smaller one. For a lot of people, it tends to be a little bit smaller. That's okay. But it's can still be sizable, and hopefully it grows over time. And those are the ones where you can trade and be a more active trader and really trade around. Number one, trade on new ideas, but also trade around your positions. I mean, and I've said many, many times, Amazon, it's one of the, it's been kind of a sideways range for a year now, but we all know it's one of the best stocks in the world for the last 25 years. And yet, if you've traded around that, it's seen huge declines and huge rallies. And you keep a core position, but every once in a while, dip in the puts when you think it gets too extended, and make some money on the way down, and then or leverage your position on the way back up. But again, that's the point of my background, working on those two important trading desks and converging not just the traditional fundamentals, but pulling in technical analysis, which is very important to short-term trading, shorter term trading, and it's also good for longer term trading as well. And then of course, a positioning, which is a very, very important play, sentiment, and those types of things. So that's really where my background comes from.
Right. And it's good that you're actually able to give that knowledge, that education, that 40 years of experience of grinding it out in Wall Street to retail traders, to young traders that are trying to get into the market and, unfortunately getting whipsawed by just not having the experience there. Everything's new, especially this market right now, considering that none of this has happened before with the pandemic and everything. This is when you have to rely on experience, on decades of experience for sure.
No question. And one of the things that's so great right now is that, we have so many people, individual traders now into the marketplace, and some old, traditional people have been doing what I do for a long time. And they just say, hey, that's a sign of a top. Well, I mean, to be honest with you, I'm worried about the markets next year in 2022, but I think it's going to create some unbelievable opportunities. But the great thing is, unlike the past, the individual investor now has a lot more tools to take advantage of the volatility in both directions. For the longest time was either you just bought a stock. Once in a while, you could buy put options, but they had to be, wait. They had, in many cases, you had to wait. You had to buy something that was 3 months out in the future. That means the time value made it very expensive to buy those options. Nowadays, we have options that expire every single week on many, many big stocks, all of the very big stocks, and most of the stocks for sure that regularly, but also in the those ETFs, you know, the index ETFs, you can take advantage of these wild moves. Those ones, they expire 3 times a week, Monday, Wednesday, Friday. So you don't have to, you can make, hey, I'm really sure this thing's getting really, really overbought for whatever reason. I'm going to buy a put here, or it's getting completely washed out. I'm going to buy a call here. It expires two or 3 days down the road. It's very inexpensive. And then suddenly you can make 200, 300, 400, 500 times your money really, really quickly.
Especially for people that usually, you know, try to not trade options because of the how expensive the calls are on the monthlies. On the weeklies, you do have, you know, lower pricing. So yeah, absolutely. I agree with you there, Matt. So, all right. So let's do a quick market overview. Go ahead and share your screen, your terminal. And we can take it from there, the overall market view. I know a lot of people they feel like they're walking on thin ice in the market. When I talk to people, retail traders, hear that they're taking very, how do I put this? Like very, very like plays that they are very confident on, right? They're not very, very confident. They don't go long as they would. They don't feel that rally there. So a general market overview of, you know, the markets that you analyze every day.
Sure. Well, let me just go in here because I want to, hope you can see, can you see it okay here on my, whoops, there it goes. Can you see my little comment there? Okay.
Yeah,
okay,
we see it.
A couple of things here. So it's funny, Rodrigo will tell you, I'm you know, since I've been doing this for a long time, my technological thing isn't as good as it usually is. So that's why I have to make sure you guys can see what I'm seeing. But anyway, but the thing is, as much as I'm old fashioned when it comes to some technologies, I tell you, I spent a lot of time keeping up with the markets and all the changes that it's made. It's amazing how people, if you haven't kept up with it, these guys are dinosaurs. And some of the stuff we're just talking about, all these changes in the options and ETFs and inverse ETFs and leveraged ETFs, and so much hasn't changed, but so much has, and we really try to keep up with it. But right now, I mean, if they're walking on thin ice, I agree. I mean, I am really. Again, over the next week or so, we're in this seasonally positive time for the stock market. So it looks like it's going to be okay. But as we move into next year, I think we're going to have some problems. I mean, the stock market is trading at more than 20 times earnings and, 3 times sales. People talk about, well, interest rates are really low. So that's okay. And so therefore these valuations levels are fine. It's like, well, I hate to tell you, but the last time interest rates were at this level, well, maybe a little bit higher, 1.6%. That's the last, that happened in 2018. Well, guess what? The Fed tightened like they're doing now. They're starting to do now. The Fed tightened and the stock market was trading at 18 times earnings. So it's already, so the 1.6%, 1.5% does not give you a legitimate 20 times earnings, 22 times earnings. It should be more like 18 times earnings or less. And the sales, we said 3 times sales. I'll show you the chart in a little while. It's way more than it was at the 2000 top of the dot-com top. And the same thing with market cap to GDP, market cap to GDP. This is Warren Buffett's favorite valuation level. By far the most expensive it has ever been. And that's what it comes, but the most important thing we're looking at now is what's going on with the Federal Reserve. Everybody can talk about Omicron and we can worry about that. That's fine. And I'm not trying to say it's unimportant, but the real issue is the Fed. Don't fight the Fed. You've heard that a million times, but the people on Wall Street, they're paid to be bullish, okay? And so they only say it when the Fed's helping. When the Fed turns, they try to find excuses why it's not helpful. But the fact of the matter is every single time the Fed starts to tighten, the market goes down. Now, it doesn't always go down immediately. About a third of the time it goes down immediately, but usually very soon. And we've already started tightening, okay? We started actually in November. It's only one time that it'd take a full year before the market really started to come down. But they are starting to tighten. And I think this time, because given how expensive the stock market is, second most expensive on some levels, and as I just showed, the most expensive on others, I think the chances that it will come down. But we can take advantage of it. Corrections and deep corrections are normal, they're healthy, and we want to be able to take advantage of it. But a couple of things I talk about here, we have this thing with margin debt. Okay, look at this level. People talk about margin debt. It's a lousy market timing tool. That's absolutely right. But it shows that there's an amazing amount of leverage in the system. Margin debt doesn't become a problem until it starts going down. We saw what happened here in 2000 when it started to go down. The market just got crushed. Again, another record high in 2007, early 2008. When it went down, the market got crushed. Look at it now. I mean, it's so much higher today, and it's starting to come down. Okay, and part of the reason that is the Fed is pulling back on their liquidity. We have a situation where the Fed is going from massive levels of liquidity in the marketplace, that those emergency levels, and we needed that. They did the right thing, absolutely. The market had shut, the fixed income market had all but shut down in March of 2020. We were staring to a very similar abyss than we were in 2008. And the financial system wasn't as on edge, but the markets were freezing up to the same degree. The Fed came in and they just plowed in this unbelievable amounts of liquidity and stimulus. That's great. We needed it. The problem is, once we got out of the emergency very late last year and certainly early in this year, and well, as we moved into this year, they kept that stimulus there. So when the stock market, when the economy fell like this, and the stock market went down, they built up the stock market back up. And everybody knew it was artificially high. And they just said, eventually everything will catch up. Well, that's fine. It started catching up, but then all of a sudden the emergency was over. The economy kept growing, but the stock market kept going too. And so it was never able to catch up. And that's where we are right now at more than 20 times earnings, actually almost 22 times earnings, okay? And therefore, even if the economy is doing okay, even though earnings are doing fine, okay. The one thing though is that earnings growth in the last quarter earnings expectations did not go up. Did not go up. As good as that third quarter's earnings were, the 2022 expectations did not go up. Okay, so earnings growth is starting to fade a little bit. But the point is, it still doesn't matter. We had a very strange situation where the market was being held artificially high for the right reason, but at some point it has to come back down and meet it. And now the Fed has made that decision. They're going from 125 billion a month to zero by March, okay? And and then they're gonna raise interest rates. That's going to pull the market down. That's going to cause these institutional investors, hedge funds, and et cetera, to de-risk, to de-lever, just like they did here in 2007, late 2007, 2008, and they're starting to do the same thing now. Okay, these are the things that we have to worry about. Now we have a situation also where China is completely pulling back. So you got the two biggest economies in the world, the U.S. economy using monetary policy to tighten back significantly on that monetary policy. And then you have China, the second biggest economy in the world, that went from more than a decade of encouraging speculation, encouraging leverage, encouraging risk-taking, encouraging debt, to clamping down on all of those. Okay, and they've been doing it for a year now. And people say that they're gonna ease off. Well, they keep saying that they're gonna ease off, and then 2 weeks later, a month later, they come back and hit another group. They are clamping things down. This is going to create headwinds. The other thing, of course, in my opinion, is that inflation is not transitory. I think that's pretty well established now. It will come down a little bit, but it won't. When the supply chain issues start to fade away, it won't come down as much as many people think it will. Because number one, I just drove by a Dunkin' Donuts today. They have a line of cars for the drive-up window. It's got to be a mile. Well, it's a mile long, but it is so long because they can't get enough people to work there in-house. So they can only have people to work the window. McDonald's the same thing. It's crazy. People are they have to raise wages to get people to go back to work. If they're going to get paid that's little amount of money, they'll just go drive Ubers or do Uber Eats, because then they're on their own schedule. They're not going to go for the small amount of money, be told where to go, when to go, and how to do it, okay? And wages are going to have to go up. And plus all of this liquidity that the Fed has been, not just for the last year and a half, but since the financial crisis. When you get that money supply to that level, inflation's going to stay up. So even though it should come down as the supply chain issues start to wane, it's going to level off at a much higher level than we've seen at any other time. And the key thing is leverage works both ways. So many people don't understand that the addition of leverage is one of the main reasons the stock market has done so well in the last year. That's why it's ahead of the fundamentals, because of all that leverage, all that froth. They've been willing to pay it. And they said there are companies out there that are great companies that are going to continue to have great prospects, are going to continue to grow earnings, but their stocks are going to come down, okay? And we're already seeing it with NVIDIA. We've seen it with Tesla. We've seen it with even starting to see that with Microsoft. And that's another thing. And before I get too far into it, I don't want to bash the economy and the markets too much. What I'm just saying here is that we are getting ripe now because the Fed has changed things. Now look at Mr. Nadella, who's the CEO of Microsoft. A couple of weeks ago, right at the top, he sold $285 million of his stock, of his company stock, half of his company stock. All right. You don't do that if you think if the stock is going higher for the next few years. Now, forget about the next 6 months. They don't care about 6 months. You know, there's a bunch of times that Microsoft's come down over the last couple of years. This is a great CEO, a great company, great prospects. He's not doing anything wrong. He has every right to sell that stock. He's just seeing it that it's gotten way ahead of the fundamentals. He sees what the Fed is doing, and he has cut. Insiders don't sell that kind of size unless they know that they're moving into a downturn that's probably going to last for more than a year or so. And it doesn't, you know, again, Microsoft will come down. It doesn't mean its stock's not going to go back up. And again, it doesn't saying the stock's going to go down for 3 years. What I'm saying is it will go down enough, and it'll take it a while to get back, at maybe several years before it gets back up to its all-time highs. It just, you go back into history. When do insiders sell? This is one of my favorite, I talk about all the time. 1999, Goldman Sachs. All those partners been partners for 100 years. They sold it through an IPO, an initial public offering. They sold their company. Okay, they kept a bunch of shares for themselves, but they sold a bunch to the company, just like the Microsoft chairman did, Mr. Nadella. Okay, guess what? Guess what happened in 2000? 1999, they saw what was coming. They saw the dot-com bubble and they sold. And sure enough, we had a horrible bear market the next couple of years crash. Okay, what happened in 2007? Blackstone, not BlackRock, but Blackstone, one of the biggest, what do you call them? PE firms, I'm sorry, private equity firms. One of the most successful, maybe the most successful private equity firm in the world. They had been private since 1982. Suddenly they decided we're going to go public in 2007, the summer of 2007. 3 months later, the stock market topped out and went down. They saw what was coming and they decided to sell a bunch of shares to the public. Same thing. Glencore, which is a Swiss commodities company, they went public in the spring of their partners sold a bunch of their shares in the spring of 2011 through an IPO. Okay, they kept some for themselves, but they sold a bunch. Okay, guess what? You know, that we had a top and a top literally 2 months later in the commodities market. They went down for 8 years. Okay, commodities had a horrible bear market for 8 years, which is bouncing back now in the last year or two. And then we could go on to, you know, Sam Zell, the famous commercial real estate guy. He saw that was a private transaction. He sold his whole company in 2006, right as the real estate bubble topped out. But you see what I'm saying is here. Insiders. Now, of course, Microsoft, he wasn't the founder, but, you know, its company's been around for 40, 50 years. But he was the one who sold and who was selling in a big way. You don't do that in a great company like Microsoft with great prospects unless you just think it's the stock. Again, he's not doing it because he's worried about his company. He's not a scumbag. He's not like, hey, he's been cheating everybody and hiding, you know, losses and things like that. He just sees the stock too high and it's going to come down. That's normal. That's healthy. It's a great thing for Microsoft. They're still going to be fine. But for him personally, he sold the stock. I'll just leave one last point on that. I don't want to go, I've already kind of ranted too long on this. But what about Microsoft, Matt? I mean, what the hell are you talking about? Microsoft went public in the early 1980s. The stock just kept going and went straight to the moon. That's correct. But guess what? Bill Gates didn't sell any stock. He sold $1 million of stock. That was it. I mean, we used to joke and say he was still living in his parents' garage. He just wanted to buy a house. I mean, he said publicly, I'm only selling such a tiny amount because I'd rather buy. I just need a little money to live on because I've been working out of my garage for the last 5 years. And so he did not sell. It was the venture capitalists, not the insiders that sold. It was the venture capitalists who wanted to cash out because they had invested in him early on and they didn't realize it was going to become one of the greatest companies in the history of the world. Okay, but the insider held on. So so just because a company goes public, goes IPO, and the shareholders and the founders sell a little bit of stock, that doesn't mean maybe they just need the money to grow their business, and they're only just selling a small portion. It's when they sell a lot. And when a CEO sells a half in a stock like Microsoft, he does it all at one time. He's already saved himself $15 million. If he'd waited this long, he would have sold it for $15 million lower. So. Again, we just talk about a couple of things here, but again, the point is right now what I want to do and what I try to do with my work, and we do through this chat room that we have. I mean, I do some newsletters. We do some stock picks. They've worked very well. I really enjoy that. But this chat room that we do, and I'm on it all day. tomorrow tomorrow's the day before Christmas, Christmas Eve. The market's closed on Friday. I'll be in the chat room for a while, but I'm sure it'll be a very quiet day. There won't be much to really talk about tomorrow. But I'll be right back in on Monday and going full throttle. I'm in all week, like next week. But the point is, a lot of people, they talk about, your investment advisor. And again, for that bucket that you have for a real long-term trader, now they want to help you weather the storm and all this stuff. That's great. I want to help you profit from the storm. And now that all these, whether it be ETFs, inverse ETFs, leveraged ETFs, and options, weekly and tri-weekly options in the case of the index options, that we can profit from this thing in a way that individuals have never been able to do before. And what I try to do also, though, however, is, for instance, in the chat room that we go on every week. I'm on it all day long. I get in around 9 o'clock. I mean, I get into the office much earlier than that, but I get onto the chat room around 9 o'clock, and we get off, shortly after the market closes at 4. But on and off all day long. And but one thing I do also on Wednesday, I do a webinar where we talk about, and we do some educational issues. Talk about some specifics on technical analysis, positioning, and just some of the insights I'm seeing at that time. But during the day, we're also all the time. Today, I was talking with a person. We're asking. Well, actually, it was yesterday. I'm sorry. Was asking on a chart, and I just and actually, it was this morning. I'm sorry. And we just talked about how he said he really thought that the stock could be a breakout here. And sure enough, I showed him. It's like, not only did what he was pointing out was good, but I said it was also a flag pattern. I drew out the flag pattern and said, if we break above that, it had already broken above that. That's good. Now it's about to break it. It's all-time high. That's good, but it's overbought near term. So my kind of feeling was that it's a real good idea. It looks really good technically, but on what I look at in terms of technical analysis for overbought, oversold, it looks like one that probably getting a little ahead of itself near term. Let's look for the next pullback to really add to this name. So we talked about, so people walk in, they go, Head and Shoulders, what, isn't that a shampoo? And then I said, no, we talk about, it's not that difficult. We try to make it, and again, I talk to some of the best and most successful hedge fund guys in the world, and I'm not talking. They don't want to hear about all these sophisticated. I mean, I technical analysis I follow very closely, but even for them, they're like, I care about the fundamentals. Give me the solid stuff, the stuff I really need to focus on in the technical side of things. And that's what I do in the chat room, so that we don't people don't get too confused and and be honest with you, a lot of that stuff is just noise for certain technicians to make them sound smart. It's really not as it looks. So they're really focused on that. So my point is, we're given ideas all the time, both from me and from other people in the site, but also helping people learn about why we're making these picks.
Hey, Matt, but I do remember actually that you did come in early one time, all right, to report on the CPI number trade. I remember that you did come in early one day.
I say getting around 9 o'clock. I mean, I'm here very early in the morning, and if there's something that happened, I'll be on at 6:30 if there's something to be talking about. So you
trade around market events and you keep
right.
Everybody up to date. Like if there's an important number that's going to come out, and you, from your 40 years of experience, already know how this song goes out at the end, you pretty much pitch in, right? Like, hey guys, these are the numbers. This is the trade, which worked out pretty well when you did that for the CPI, I believe.
Right, that inflationary number was higher than expected. We went out and bought some index put options, and it worked really, really well. And then today, very simply, I just punched out the most active options and saw that Tesla was that the volume in the Tesla $1,000 call options were we knew the stock was already up and trading up. It's like, you always worry when a stock opens up and opens higher. It's like, is all the news already in the stock from overnight and it just gapped open? But I say, well, obviously these guys don't, because somebody out there is buying the call options hand over fist. Somebody thinks they know something, and let's get in. And that's when we jumped in the stock. And I'll show you, I have the chart on it, but we made about 170% in just a few hours. Then the stock came down again. People came in and said, geez, we made a nice profit. Is it too late? I go, no, the option's almost back to where we bought it at 9. I think it was 9:50, 9:48 in the morning. I said, no, it was at 1:15. I said, no, let's get right back into it. And sure enough, it didn't go up quite as much, but we were made, depending on where you bought it, where you sold it. If you held it all the way to the close, which I did, I didn't suggest. I came in and said, hey, you got made about 75, 80%, but literally in 2 hours.
So 170%.
We react to.
So 170% on that one. It was like 300 something on the QQQ calls, 250 on the QQQ puts. So you were trading in on the way up and down. This sounds like something that, I mean, you're very familiar with the markets, but it sounds like you're very in tuned, right? I mean, you have a ton of picks there. You can show them.
Well, yeah, I don't want to
But
bore you guys too much. I'll go back to my my Bloomberg thing there. But yeah, we can go back to some of those things. But yes, the whole idea is to be willing to trade. You know, let me just one other thing here while we have it here and while we were talking about it, because let's see here if that's the one I want. And then yeah, and this is, and I'll, so you can see it better. But this is another thing we do. I mean, I try to do here. Here's a situation where we have the energy stocks. This is the XLE Energy ETF. And this was before we started this chat room. I was doing other things with Benzinga, the other tier stock picks. But in my calls, whether it be on CNBC for Miller Tabak, our institutional clients, and on CNBC and Bloomberg TV and Yahoo Financial, I'll be on Yahoo Financial next Wednesday, I think, at the opening, and Bloomberg TV at the close next Friday. I'm on CNBC, I'm 1:30 on Tuesday on CNBC. Anyway, enough of that. This is but this is what I did. I started pounding the table on energy stocks, and again, I used the fundamentals. Everybody hated the fundamentals. They're saying oil, fossil fuels are dead. This is last September of 2020. Let's go in. And I said, okay, I looked at the fundamentals. They're finally starting to get better here with this. I noticed that the spending on infrastructure for getting these fossil fuels out of the ground had gone off the cliff because of the green energy. And I totally understand. I'm all for green energy, but it's going to take us decades to get up to snuff to where we need to be to fully have enough of it to hit the demand. I mean, the IEA, International Energy Association, said we're going to have pre-COVID demand for fossil fuels within 5% of where it was pre-COVID through the end of this decade. Okay, not just saying, and they're taking into account all these new green energy sources, but it's going to take we're still going to have to rely on fossil fuels, but because on the fundamental side we had so much of a cutback in the spending on getting that stuff out of the ground that we can't recover. The U.S. can't go back to what it was. I'm not saying Trump is better than Biden. I'm just saying that he spent a lot of money on it. Biden pulled back on that money. That's just what happened. It's a fact. I'm not trying to get political. I don't care about politics. I care about where stock's going to go, where commodities going to go. Well, what these guys do? How does it? I don't care who should be president, who shouldn't be president. I care about what they're doing and how it's going to impact the markets. And I saw how it would impact. I saw that the supply side of things was falling. But also, I looked at the positioning. The commitment of traders data showed the futures traders had one of their largest short positions ever in the commodity of crude oil. And sentiment, the bullish sentiment on crude oil was at like 7%. Nobody liked it. Nobody liked it. Okay, and that's again the futures traders. The positioning on Wall Street. Forget about the futures traders, the short-term traders. The Wall Street, all the mutual funds, the smartest guys in the business, they had the lowest holding weighting in the equity area and the energy area in decades. Okay, so there was nobody left to sell. And so I started pounding the table and said, let's buy. Now, it didn't work perfectly. It went down for a little bit, but we kept with it because it didn't fall down it didn't fall that much. And then it took off. Okay. The other thing, though, is that the reason why I bought it here is look how oversold it became. This is the RSI chart, Relative Strength Index. Whoops, what happened there? I just went, sorry about that. There we go. And relative strength index. Okay. And this tells you, it just talks about how, how strength, it measures buyers versus sellers and how the strength and the volume involved. And when it gets down here to the green level, the green line of 30, that means it's getting oversold. And it's green because it says, go ahead and buy. When it gets up to the red line, which is 70, it's something where you want to sell. Again, stop. That's why it's a red line. Stop. Okay. It was deeply oversold. It got below 30. I got in a little early, but it was okay. It started to run. Okay, now it got up to here and people are saying, hey, the RSI is getting overbought. And I was like, no, I still like it. I like it on long-term basis, but we're going to stick with it. It came down a little bit and people said, oh no, see, I told you, it's starting to roll over. This thing it was just a dead cat bounce. This thing's going to roll over. And I said, no. Instead of selling here when people are starting to get nervous, I doubled down. Why? Because I saw what's called a golden cross. This is the 50-day moving average crossing above the 200-day moving average. You can't see it on this chart, but you go back in history, every time that happens, it is really, really bullish, okay, for the XLE. Okay, so for the XLE, for the energy stocks. And sure enough, so we rode it all the way to the top. This time, okay, when it got overbought, it was no more overbought than it was here, but we didn't have any of these other indicators. And I was looking at sentiment, which had become much more bullish, positioning, which had become much more bullish. And I said, take profits. And so we traded around position. I didn't say sell your whole thing. I love oil longer term. And so I said, cut your positions in half, take some of your profits and buy some put options. And sure enough, look what happened. It came down to here. I liked it here. Again, I saw the position. It didn't get incredibly oversold. But since I liked it longer term, I told people, let's go back to a full position. But we did the same thing when it got up here, got overbought. And again, and I'm sorry, when we got in here, we bought some call options here too. So again, by the time we got through with trading this in a real way, I mean, we weren't perfect. I never pretend we're getting, anybody who claims they get the exact bottom or exact top, no chance. And even here, it's just the way the thing was circled. I didn't get the exact top. It was really here. Here, I almost got the exact top. But the point is, this is how we trade around these things, go back to a full position, and it's worked out really well. Now, this chart is one that I drew up a couple of months ago, but it still worked really, really well for us. And I got more cautious on the energy stocks in November, and now I'm bullish again. When oil pulled back down towards that low 70s, I turned bullish again, and it's worked out really well for us. But these are the types of things that we're constantly doing, where you're not just looking at, okay, what looks really good today because there's news out in the stock. What do we own? What do we like long term? And what should we be doing with it? Let's trade around those positions so we can maximize our profits. And I guarantee you right now, this has been a great move from 25 to 50. I mean, that's more than 100% in just over a year. Guess what? We're up about 170% because we took profits here, bought it back lower, bought some puts here, bought some calls there, bought some puts here, bought some calls there, et cetera. And the options on these index ETFs are very, very liquid, and they're weekly as well. They're most of them. I can't think of one that goes for a group that happens more than once a week, but still they're weekly, and so you have the ability to trade them pretty easily. So. These are the type of things that we do. Now, I can never go without a presentation without talking about my best one. These meme stocks. Again, we're talking about fundamentals and talking about technicals and trying to combine them both to really do things. Now, we saw early this year, this is a very multi-year chart, okay, and this is a weekly RSI. I talked about that RSI, a weekly chart. Obviously, this is more of an intermediate term indicator rather than a short-term indicator. But if you look at this stock, I mean, Viacom, okay, you saw these meme stocks. We saw it earlier this year. It was when GameStop was running and when AMC was running, and the meme stock thing hadn't really taken off yet. There was only a few of them. And I was looking at Viacom, and I'm like going, okay, Viacom, it was a huge short interest. That's the only reason why the stock's going up. It's like they're not going to come up with something that's going to save, cure cancer or a new vaccine for COVID. They're not going to come up with a new iPhone. It's a great company. Don't get me wrong, but this is ridiculous. And I kept watching it. When the weekly RSI got up into the mid 100s, I was like, okay, this is just ridiculous. Let's buy the puts. Went out and buy the puts. In less than 2 days, made 2,500% on our on the puts. Okay, 2,500. And I was early. There were some guys who held on to it and made 5,000%. And there were one person, at least said that it was over 10,000. Theoretically, if you bought where I said to buy them and sold them right at the top, you made 12,000% on those put options. Anybody who held on to that long was crazy. Some people held on to that long and they rolled back over. But either way, they made lots of money. And that's, I wish I could say this is something we do all the time. But I just saw this RSI. I said, oh my God, this is so ridiculous. This is like shooting fish in a barrel. It's too outrageous. I wish we could say we get one of these every month. We're lucky if we get one every year. But these are the types of things that we're looking for, the key turning points, because that's when you make the big money. And I was talking about the market overall. We're going to have a time where next year, where again we've seen this choppiness. We've seen this choppiness in the last couple of weeks. that's been frustrating. We've been able to, we've lost some money on some trades because, we stuck with a put option on some index ETFs and it bounced right back. And now, we lost some money, but I'll show you how we've hedged ourselves also. That's worked out really well. But the point is, choppy markets at the top are signs of a top. Okay, if a market's little choppy, that's fine. That just, maybe it's a sideways correction, whatever you want to call it. But when you see these big moves, we haven't, as I said, there've been 2 days with the stock market since Thanksgiving. 2 days where the stock market has closed, only 2 days, less than 0.5% up or down. Okay, where we went over the summer where we didn't even get 0.5% any day. Okay, these are these huge moves. That's a sign of indecision. That's a sign of an unhealthy market. It's the same thing with what's talking about everybody. It cracks me up when these guys say, hey, the market's already corrected because, the average stock is down 28% in the S&P 500. So most of the stocks have already corrected. So therefore, the rest of the market's going to go back up. And it's like, well, that's sounds good, but I can't think of a time where that happened. And I know from my experience in almost 40 years, it's usually the other way around. Usually the big stocks go to fall down and play catch down instead of catch up, play catch down with those other stocks. And it makes total sense. I mean, we've heard everybody's heard a million times, a narrow rally isn't a good one. We want a lot of stocks participating in a rally. And if these stocks are going the other way, that's bad. My analogy is a house. Okay, you have a house, you have termites in it. If the termites have come in and eaten away at 28% of the wood in the framing of the thing, that is going to be really wobbly. That is not good. Eventually, the market's going to the house is going to keel over or lean. But what we've had lately, of course, is we've had braces holding up that market, holding up the big cap names. Okay, and that was the Federal Reserve. Well, guess what? Those braces are being taken away. So that's going to make it even more wobbly. As we get into the new year, in my opinion, year end and also some window dressing and things that institutional investors like to do should be able to hold up the market. We get into the new year, and I'm not saying January 2nd or January 3rd, but in the new year, this whole change in lack of liquidity from the Fed, don't fight the Fed, is going to make it much more difficult. And the other thing I would say also is that, and when we talk about steroids, I think that's the other analogy. It's really good. People will say, well, the Fed's still supplying some liquidity. Well, yes, they are. But, it's going to shrink rather quickly, very, very quickly. And so what I'm looking at is a situation like a weightlifter who uses steroids. If they use a lot of steroids, they finally decide, I can't do this anymore. It's not good for me. I'm going to start going off it. And they gradually go off it. Well, they're not going to be able to lift as much weight as they pare back on the steroids. The amount of weight they're going to be able to lift is going to be lower. And then finally, it's going to go down to the natural level. That artificial strength that they have is going to go back down to the natural level. Hopefully, they haven't hurt themselves by taking that stuff for an extended period of time, and they still remain strong. So as the Fed pulls back, that doesn't mean that everything has to implode and we have a repeat of 2008. I'm not saying that at all. What I'm saying is that as we come off those steroids, and when it gets to zero, even if we're still strong, we're not going to be as strong as we were, and the stock market has to come down to meet the fundamentals, come back down and meet in the middle somewhere. Thanks, buddy. So anyway, so the thing is so we're running into these things that we want to be able to take advantage of, and I hope we get some opportunities like this with Viacom next year. The chances aren't very good, but and I just want to go one other thing too, and kind of bouncing around here, and I apologize, but we're talking about with situations I showed you with RSI, the relative strength index. There's another thing we look at, and this is the MACD chart, and this is a measure of momentum. Now, we talked about. A lot of people have heard about this, and I talked about it earlier, about a golden cross or a death cross. A golden cross is when a 50-day moving average breaks above the 200-day moving average. And that, it doesn't happen right at the bottom. It doesn't catch a bottom, but it does say that momentum is turned to the upside and should last for a while longer. And of course, if you get a golden cross on a weekly chart, it's even more compelling. Well, we also have, it's in the same kind of feeling as we have as the MACD chart, which is a much shorter term chart. It compares the 9-day exponential moving average versus the 12-day. And when they cross to the downside, that shows that momentum is getting weak, and to the upside, and when it goes to the upside, it shows momentum is getting strong. And the thing about it, with some stocks, it is really compelling. With many stocks, the MACD is a very, very compelling event. But with some stocks, it's wildly compelling. And this is what happened with NVIDIA. NVIDIA earlier this year, now this was in the summer, okay, and we made some nice calls on NVIDIA since then. But this is what happened this summer. And again, just for an educational thing, this is what we had. We had right here, I went back and said, look at this MACD cross. The stock is acting really well, but we have MACD cross here. Stock went down. Look how much it went down. MACD cross here. Look how much the stock went down. This time, in both of those instances, the RSI was also overbought. This time we're getting a MACD cross with it ridiculously overbought, okay? So, and it was the most overbought it had been since September of 2020 when the stock, when the whole technology group got hit hard. We had a deep correction in the NASDAQ. Well, look at this. This is the NVIDIA 5 days later. The MACD cross obviously became more pronounced. It went from very overbought to almost oversold, and the stock dropped 12% in about a week or two. Okay, 12%. Guess how much the puts went up? You bought puts in that time when we were talking about this. I mean, they were up 300 or 400%. So, I mean, the point is using this technical analysis is something that works really, really well. Fundamental analysis is so important. But I'm telling you, all the best hedge fund managers, Paul Tudor Jones, Stanley Druckenmiller, David Tepper, they all look at the technical analysis. And I'm going to tell you in just a second why that is, because it's really fundamentally based. But and here's another thing we look at is moving averages. Okay, Chevron. Okay, Chevron. This was again earlier in the year, but Chevron, it bounced off its 200-day. It got down to its 200-day moving average. And I said, will it bounce again? Well, it probably will, because it's more oversold here on its RSI chart than it was the last two times. So it's even more likely to bounce off that. And sure enough, he said, let's go in and buy the stock. Oops. I don't have the chart, but anyway, we made about 250% in just 3 days in the call option in that. So we're using that this technical analysis to help us for the key turning points in a stock, because the long-term fundamentals don't tell you those key turning points. It's the positioning and the technical analysis that helps you do that. And again, I don't want to ramble on too much here, but the one thing I do want to talk about though is this thing about technical analysis. And people constantly say, well, it's just a bunch of lines drawn on a chart. And I've heard, I heard one time a guy from a very big mutual fund, very successful guy, and he was talking at a cocktail party. It was a big fundraising thing. And I wasn't really in the conversation, but I was standing with the people, and he was talking about how technical analysis is a bunch of mumbo jumbo. And then, a little bit later, he said, 10 minutes later, he was still talking and pontificating, and he said, well, the economy tends to move 6 months after the markets. In other words, the market turns down 6 months before the economy falls into recession, and the stock market rallies 6 months before it comes out of recession. And he said the same thing happens with stocks. The stocks rally 6 months more before the fundamentals turn and roll over 6 months after they turn down. I'm sorry, the stock turns down 6 months before the fundamentals really turn over in a major way. And I stepped forward and I said, well, that's technical analysis. And he looked at me like, what? And think about it for a second. If you're a company and you've had some tough times, like a lot of these oil companies did for a while, and you've had to lay off people, you've had to close plants, you cut back all your spending, cut back your advertising, et cetera. Well, guess what? And then say these things stay down for a while, like it did for the oil industry. All of a sudden, things start to get better. Great. Okay. These mutual funds, they all have an army of analysts, and so do these big hedge funds, an army of analysts, and they're going to look at it and say, oh my gosh, I've been talking to this company, I've been talking to their suppliers, I'm talking to their customers, they're turning up, their business is turning up, and they're hiring new people, and they're going to retool their plants, and they're going to they're going to build new plants, they're going to advertise more. The thing is, though, you can't turn that overnight. It takes you time to hire those people. It takes you time to train them. You can't just retool a company, a factory overnight. It takes a while. So the point is, when they see their demand pick up, they make the decisions, but the earnings aren't going to get better for 6 to 8 months or 9 months or even a full year. Okay, are you going to wait? If you're an analyst at a mutual fund, you're going to go into your portfolio manager and say, "Hey, things are really turning around there. Don't wait for the earnings to turn up. They are going to turn up. Demand is huge. They're going to turn out. They're making the investments. This stock's going to go out higher. So the stock starts going up in advance. That's why stocks go up six months in advance. And same thing too. Things go back lower. It's like, well, wait a minute. Why would they? Well, people are human. They don't want to lay off people immediately. Let's hold off and see if we can turn things around. They drag their feet because they're human beings. They don't like laying people off. So there's this lag in between it, and the stock market is the one that tells us what's really going on beforehand. And so that's why I follow. That's why I found it very, very compelling over the years, and it's worked very well for me and for a lot of people for a long, long time. So this is one of the reasons that when people say that's just a bunch of lines drawn on a chart, it's not an exact science. There's no question. It's an art rather than a science, but it can really tell you a lot about what's going on with a stock. Again, this was just another example. What happened? Amazon earlier in the year, it got right up to it's the top end of its sideways range. It was seeing a MACD cross, and sure enough, the stock got hit. But anyway, that's really we talked about weather the storm, and we did NVIDIA. We've done a bunch of these things. But anyway, let's go back to let me escape here. Let's go back to my thing here. Okay, here we go. So this is Tesla here. And just talk about what we did today. So how did this work out today? How were we able to make money in this? When we talked about it yesterday, we were talking in the chat room. People asked me, what do you think about this stock? It's got, it's oversold. We looked at its RSI, its relative strength index. And you say, okay, this is a stock that I worry about has been pushed too far, too high. And I like the company. I was skeptical 8 years ago, I must admit, but I've had a lot of good calls on this stock. But there's no question in my mind that it's ahead of itself because of all the liquidity that's in the marketplace. We're going to have to reprice it. I think the stock's going to have to come back in over a longer period of time. So I'm not saying if you own the stock, I'm not saying sell it. That's not what I'm saying. What I am saying is, if you want to buy more shares, I think in your long-term bucket, hold off. I think you're going to get a bit lower as the Fed cuts back on the stimulus and the big institutions, billions, trillions of dollars of money will have to be repriced or de-risked, de-risking process, de-levered. The stock will have to come down a little bit. That's okay. But that doesn't mean we can't take advantage of bounces along the way. And so we've made some nice calls here. We caught this one very nicely with buying some puts. But just what happened yesterday, I talked about the stock, and people were on the chat room were asking me, what do you think here? And I said, well, I'm worried about it on an intermediate term basis. But look how the 100-day, people always talk about the 50-day moving average and the 200-day moving average. But look at the 50, it got down to, broke slightly below it a bunch of times, but each time was able to rally back above it. Then it came back and got right to that line here in August and rallied very nicely off of it. Well, sure enough, yesterday it got right down to that level and bounced. And so I said, okay, here's where we want to start looking and buy some call options in the stock. And even though I think it's a good chance it breaks down below 1,000, stays there for a little while. Near term, it looks like it wants to bounce back and regain that 1,000 level, and sure enough, it did. Now I'm going to go back to my little presentation there. Hold on, it's going to take me a second here. Okay, S&P. That's what I talked about earlier. There we are. There is. Okay. This is the one. Okay, good. This is what we're doing. I'll put it out so you can see it better. I'll put it back up here. Okay, so this morning, this is when we came in. I talked about this earlier. The stock was already up. It's like, geez, it bounced strongly off its lows yesterday. We made some money there. But what about today? It's already bounced a decent amount. Okay, on a percentage basis, it went from, well, I'm sorry, these are the call options. There's the call options. So you see, geez, if we bought them right on the opening, we'd have from less than $5, and we missed. Did we miss it? Did we miss it? That was the question. And I said, I don't think so. Okay. Came in and I saw that all these people were buying the calls hand over fist. So we came in here and we bought them. Okay. And sure enough, the stock went up here 176%. Now, did everybody, again, some people actually bought a little bit cheaper because they didn't see it. People go off the chat site for 20 minutes, an hour, whatever, sometimes a couple hours. You're not always on that. Picked it up later and made a nice profit. And did they sell? Maybe they got out here. They still doubled their money. Nobody ever gets to the top there. But Anyway, and it did go down afterwards. I was actually off, so I didn't make any comments here. I had to go into a meeting, 2-hour meetings. Not, I luckily don't have to do that too often to keep on top of these things. But then I came back and I said, and people said, okay, we came back at 1 o'clock, and people were saying, what do you think now? And I said, it's come way back down. I like it. I still like it. I think it's going to close above $1,000 and on the common stock. So I said, let's go right back into it. And same option, the exact same option. And we went in and we bought it. And right here, so we bought it here at, I think it was 137. I can't remember. And some people, even if they didn't react right away, they got it down here. By the time I said sell it, okay, it was up 59% in 2 hours. 2 hours, we made 59% on that call option. Now, the stock, actually, this option closed even higher. You would make 70%, but I can't take credit for that. Some people did wait, and some of the guys in the chat did wait and made a little bit more, but I can't take credit for that because I didn't do that. And what I do too is that when I give these ideas, a lot of people say, no, I'm gonna hold on to it, or hey, I'm gonna pass on that idea, or when they sell it a lot sooner than I say sell it, and believe me, there are times where they have. That they've done better than I've said that they would have done, or they lost less money. I truly, I mean, like if anybody claims that they 100% of their picks are make money are full of baloney.
Hey, Matt.
So we always want to make sure that we keep that a thing. But just one last thing before I end up, but we just talked about earlier the other QQQ trades we made. We made this one here. Now this is a put option we did last week. Okay, I really was bearish on the QQQ, and I went for the Nasdaq because that had the most froth in it. And sure enough, look at this. In one day, we bought this put option at just after 3 o'clock, and as soon as it opened the next day, okay, as soon as it opened, before it opened at 9:15, I'm on the chat saying I'm going to sell my options. Okay, either right at the opening or just after the opening, within the first 4 or 5 minutes of the opening. So again, I can't claim that everybody got the exact top, okay, and got 246%. Maybe they only got 230%. But again, in one day, but really came down to less than an hour of trading when the market being open, we made that money. And that worked out really well. These are the types of things. Now, the next day, though, a couple times, sorry, as you see, what we did at another time, wait a minute, I just want to say I had this right here. Whoops, I apologize. Yeah, 17. So earlier in the week, I was really, we owned some of these puts, some QQQ puts, but I was nervous about it. And I said, okay, what are we going to do with these puts? We're getting towards the middle of the day. And this was the day that Powell spoke. And the market had gone down for a couple of days in a row. We'd made some nice money in a couple of different, the NVIDIA puts, Microsoft puts, the QQQ puts, the SPY with the S&P puts, and we owned a bunch of them. And I'm like going, I'm getting nervous here. We need to put a hedge on. And the thing is, so what we did was went and I said right here, about 20 minutes before Powell started to speak, I said, we got to buy some call options to hedge ourselves. Okay. So, and sure enough, and then the same thing happened the next day before the market opened. The market rallied strongly into the close. It looked higher in the opening in the morning, and I said 20 minutes after 9, I said, we got to get out of these. These are up over 300%. Now this is one we really did. We got it right at the top. Again, if you sold it a little before, 350%. But and I love to say, so therefore, every single trade we've had is a winning trade. This one actually, what it did, it helped enable us to not lose money on the call on the puts that we had. So we came out flat, and that's but that's good. That's what we're trying to do. My point is we're constantly making those calls because every once in a while we have one that really looks like it's going to work, but we have something that's going to, you don't always know that something's happening, but there could be an important number like we talked about earlier, the CPI. In this case, it was a speech, but something that's coming, earnings report. This is going to be really important. So we don't know which way it's going to go. But when you're in the options market, you buy, it's like when you buy a straddle that some people do, but it's like, hey, if you buy and short a stock, I mean, you're going to make and lose the same amount of money. Not with options, because you make 300%, okay, and you can't lose more than 100% on your option, right? So I mean, even there, so you sold your options at a loss, okay, it wasn't 100% loss, but you sold your put options at a loss. You made more than 300%. you made money. And in this case, we had more puts than we had options, so we really just kind of came out even. But my point is, we have things that don't work, that look like might not work, or ones that are working for us. Like, it's a better way to put it. Ones that are working for us, and then we can still hedge our bets in the options market. And that's why we're constantly working on this stuff in the chat room. Okay. Let me just go back here to the, so one of the things, again, I want to go back to what we talked about earlier about education, and constantly people are asking stuff. One of the things I definitely, we talk about people's positions all the time, but at the same time, everybody, we've got, people on the chat, they've all owned many stocks. I can't make a comment on every single little, should I hedge this? That if I was doing that, I'd never have time to do anything else. And, but we focus on, but not just my picks. I mean, people are constantly throwing out things. There's a couple of stocks I'd never, well, I say never heard of, but I'd never really looked at seriously, where we've made some nice money in the options. We haven't done this one in a while, but here's one. I'd heard of it. I've heard of Upstart, but I didn't know much about it. We made some nice money in here, especially when this thing fell in the puts. And we actually, when it broke out here, we made some nice money in the calls. That was early in the year. Recently, if we had bought some puts, we would have made money. That just wasn't compelling enough to me because it was oversold. And you can see this RSI was getting oversold. So I still wasn't really, well, if anything, I wanted to look at some calls. And we played around on those. But again, stepping back 1 second though. One thing that's so important with trading, no matter what it is, on your short, if you have your long-term trades, even on your long-term trades, you don't want to lose a lot of money, okay? If you're just owning the stock, forget about an option. You just won't buy a stock and you think it's going to be the greatest stock in the world. If it goes down 10% from where you bought it, get out. Get out, cut your loss, and look for another entry point. I'm not saying that the idea is a bad one. It could be a great one. You just missed the timing. That's okay. Then once you get in, but when you buy a stock and it starts to go up, don't be afraid to buy it. I mean, you buy that stock, there are guys who are running mutual funds for 20 years, and they've been buying Apple every single year, every week for 20 years. They've been trading around the position. Sometimes they sell it, buy it, but they've been buying it, net buying it for years. And the thing is, it's like when you get a stock where you've been buying it on the way up, well, yeah, geez, you can get mad at yourself that you wish you'd bought more right at the beginning. But don't worry. If you buy a stock at 20 and it goes to 30 and you buy more, your average price is 25. Okay, you bought 20 and 30, the average price is 25, it's trading at 30. You can't lose money. You have a stop at 25, stock comes down, you're out for no loss. And then as stock goes higher, you raise your stop out level and you're guaranteed, unless, they could gap lower because they declared that they're crooked or something, but you're all but guaranteed not to lose money. What happens though if you buy a stock goes at 20 and it goes to 10 and you buy it again there? Okay, now you own it at 15, but it's trading at 10. You've just added to a losing position, and you still got a losing position. Now, again, there's nothing wrong with if you buy a stock and you add a little bit, you buy it at 20, and you buy it at 1980 and 19 and a half, or what do you want to do? That's fine. And you kind of live here. But once it gets down a certain amount, it's like you got to get out, cut your losses, move on to the next thing. Same thing in the options market. We do have more leeway in those because you saw today some of these markets. We try to keep it around 20%. But depending on the stock and the situation, but we've had something that we're really working on now is a lot of people have been holding on to some options, some losing positions too long. So that's my new thing is we're doing some upgrades to the website where we can really see all the picks in a better way. So it's going to work out really well. But the point is, risk management is so very important. We want to let our winners run. And we want to cut our losses on line. You want to batting 300 in Major League Baseball, you're going to get paid millions and millions of dollars. If you bet 320, you're going to make gazillions of dollars, all right? You bet 320 in the stock market, you're not doing so well. We're looking to bet 700, 800, but we're not going to bat 1,000. We know that. And the key is cut your losses and move on. And let your winners ride. And that's why you raise that stop loss so that, again, and of course I said 10%. If you own a great stock and it's up 100% over, in the last year, you're not going to put a 10%. You're not going to put a 10% stop on that because it's had this big run. You've got a huge profit. It may come down 20% and then go right back up. As I mentioned, all these great companies have seen big declines over the years. So in your long-term bucket, once they're in the profit, Yeah, you're fine. You do want to raise it because you don't, things do change. I mean, I keep telling my kids, someday Apple is not going to be the best company in the world. I mean, you talk to my parents, my father's 91 years old. I mean, the thought that GE has fallen as much as it has, that Sears Roebuck has gone out of business, it's beyond their comprehension. All right. So, even great companies have, and Microsoft was a great company and then was a dead company for a decade. And now it's a great company again. So, but my point is risk management and portfolio management. Cut your losses, let your winners ride. And that's how you really get maximize your returns in this game. Okay, let's just sit here. But again, what we're talking about here with the overall market, and is the I just want to talk about something here about the S&P 500 index. Oops, index. This is something that concerns me on a longer term basis anyway, just on a technical basis. But the number one reason I'm concerned is, no question, it's the Fed. And what the Fed is doing is the right thing. Okay, they should have done it earlier, but you can't. These people will say if the Fed makes a policy mistake, it's like, well, I'm sorry, but the Fed's job is not to, it's not our God-given right. Okay, I'm going to go back further. God-given right to make money in the stock market. Okay, I mean, people lose money in the stock market and have been doing it since God was a child. Okay, and they're going to continue to do it at times. And the markets are going to. Bear markets haven't gone away. Corrections haven't gone away. They are alive and well, and will continue to be alive and well as long as we have capitalism. They're part of capitalism. They're an important part of capitalism because they wring out the excesses from time to time. But this is a thing that we have here with the S&P 500. This is what you call a rising wedge. And you might think, well, the name with the term rising, that must be bullish. Well, actually, if you look at triangles, they have a thing called an ascending triangle. Well, that is bullish, or usually, and it can work both ways. But and a descending triangle can be is usually bearish, not always, but usually. These wedges, they're the opposite. In fact, people call it a rising wedge, and of course it's a wedge because you can see it's just wedging together. A wedge is the official name is a rising wedge, but most people will call it a rising bearish wedge. Of course, the other way would be a falling bullish wedge. And the fact that this has been going on for, some people draw the same kind of chart going all the way back to 1982. But the point is, once we break down below the lower end of the range in any kind of significant way, it's going to cause some problems. And we want to take advantage of that. Don't fear this thing. So, oh my gosh, here's people. And again, there's some people going on and said the world's coming to an end. The stock market, we're all going to be, guns and butter and stuff like that. I'm not talking about that. I'm talking about what could be, though, a deep correction, and down 15, 20%. Very, I think, not just possible, but probable. And if we're there, if we're nimble, we're getting in and out and trading around the stock. And if I end up being wrong, we can still take advantage of it. Okay. And that doesn't mean, well, another part of that though, too, is going to be raising some cash. Not a lot. I mean, I love it when people say on TV, they say, so-and-so was bearish on the market. And he missed a 20% move. And I'm like, so you missed a 20% move. And I'm like, well, no, he didn't. That guy said, raise 10% cash. He didn't say go to 100% cash. He said raise 10% cash. So he missed a 10% move on 10% of his money. Okay. No, that's not good. You don't want to do that. But with what we're facing right now, with the incredibly expensive market, with the Fed that's changing their turns, their stripes in a major way, China clamping down, we want to raise a little bit of cash. And if we get to a point where we realize it's breaking out of this wedge to the upside, and we want to change our mind and get back in, so we'll lose 3 or 4% on 10% of our money. What do we care? Okay, but if you have 10%, it's like, well, then why would I care on the way down if the market's going to go back up anyway? This is why it's important. If you have a little bit of cash, 5 or 10% cash on the sidelines, and more importantly, if you can take advantage of the dips and make some nice profits with these dips, now you got even more cash. What happens if the market's down 20% or even more than that? That's when people panic. And the thing is, when markets get down this much, it usually involves forced selling. People got margin calls. Remember that chart I showed earlier, how the margin debt is at all-time high. They don't. when you get a margin call, you have to sell. You have to sell. I don't care what you think about the fundamentals of it. You have to sell. And that's when, but what happens is people who don't have to sell also sell because they're panicked. Oh my gosh, it's human nature. The market's going down. It's going down forever. I got to sell, sell, sell. Okay. So the people are being forced to sell because they're margin call. You have people who are panicking. Okay. How do you avoid panicking? The people who have 100% of the market and money in the market, you can't blame them for panic. It's like, oh my God, it's my kid's college education. I got to raise some cash. All right. And then when the market bounces back, they're like, oh, I just sold a week ago. I'm 2 weeks ago. I'm not going to buy it back now. I'll feel like an idiot. And even though nobody's going to see what I do, I'll still feel like an idiot. Well, guess what? If you're the one who's got some cash, made some money on the way down, okay, you're going to be the one who's stepping to the plate. When people around you are losing their heads, you're going to be the one keeping yours and buying. Now, even if you don't buy the exact bottom, and maybe you get in there a little early and then buy a little bit more, or a little bit lower. But even if you wait until it's starting to go back up, like I said, 2 weeks later, when it's pretty obvious the market's turning up, the guy who just sold 2 weeks ago is like, I just sold my stock. I'm going to wait for it to come back down because I'll feel like an idiot if I just buy back stock I just sold 2 weeks ago. You're not going to care. You're like, okay, I missed a bottom. I don't care. It's going. I just been sitting on cash and I'm going to buy. And then remember I talked about that thing. You'll be adding it to it on the way up. You'll be buying it. You'll be buying it at 15, 20, 25, and you'll be at $50 with an average price of 22, and you're going to be sitting real pretty. You can move your stop loss to the thing to 35. The stock's trading at 50, and you're going to feel real good. But it gives you that confidence. Confidence is so important when it comes to trading and investing for that matter. And when you see situations like these, when the market's really expensive and the Federal Reserve has changed their policy in a significant way, it's just a good time to be okay. And be okay if you end up being wrong, you miss it again. If you went to 100% cash, then you feel bad. Then you feel like an idiot. But if you go raise a little bit of cash, that'll be the thing that can help you weather that storm. And again, profit from that storm. You'll keep your head and you'll be buying when everybody else is selling, and you'll be adding when other people. So that's what happens. The thing finally gets washed out. And so those people, most of those people, they don't wait. The thing bounces back after 2 weeks and they sell more. And the thing, and you're buying. So this is what we're trying to do here is help people learn how to fight the natural impulses that most human beings have. And there is sometimes it's the right thing to do is to panic. I love avoid panic now and avoid the rush. That's not really good. That's not good advice. It does work every once in a while. The market's down 10% and ends up going down 30%. But the point is, if you have, again, eventually the stock market's going to come back. It always has. And again, inflation. The system is built so that we have inflation. Even though we haven't had much inflation for 30 or 40 years, prices have still been going up. And even with all the deflationary things of technology, in general, you're still paying more for a car, still paying more for your clothes and things like that. And so that's just the way. So naturally, stocks are going to go higher over time, but we want to be able to take advantage of those. And in this chat room, this is something that we've really been able to do in the last. And again, we've only been doing this for about 6 months now, but it's worked out really well. And I just like to again not just share ideas, but share the reasons behind what I'm doing, and when at least what I'm thinking, and look at it a broad picture, then take it down to the smaller one. We look at the fundamentals, we look at the chart, the individual ones. The technicals, and the especially positioning. I haven't talked a lot about positioning, but that is really, really important, because when too many people get on one side of the boat, it causes a big problem. Now, I'm going to talk about Microsoft a little bit. We mentioned it yesterday. We didn't jump on board this one when it broke above the 50-day moving average. I mentioned it yesterday to people. I was like, maybe we should get on this. And I think maybe some people in the chat room did. And if they did, they did well. I mean, the stock only went up a couple of dollars, but if you own the call options that expire tomorrow, because of course they expire on Thursday this week because Friday the market's closed for Christmas, people made some nice money. But it goes back to what we're doing here. We go back to what I said earlier about the CEO of Microsoft. Great manager, great company, but very telling that he sold a lot of his stock. So this is what I'm going to be watching as we get into the new year. I just want to get rid of those, I want to get rid of those lines. Those are the moving averages there. Let's just draw this line here. I'm going to be watching very, very closely. It's basically $320. You see, it's based 318. Those are the intraday lows. A lot of technical analysis, you look at the closing levels, but I'm really in short-term trading. I like to look at the intraday levels as well. And okay, on one hand, okay, first of all, it's not a pure, it almost looks like a head and shoulder, but this shoulder is enough. But the point is, one of the biggest things, whenever you see a stock making higher lows and higher highs, higher low, higher high, and all the way up, that's good. You know, bottom left, upper right, that's good. And if it's making lower highs and lower lows, of course, that's bad. Here's a situation where stock's been making, and I've blown it up here, but you know Microsoft's been doing very, very well all year long. But you see how it's flattened out here. It's lost its upside momentum. So I'm worried about that. And so what I'm worried about here is if it breaks below this level, it's at almost five different days, if you really include yesterday, because it got very close to that level. 5 days recently, it's been able to hold that 318 level. So buyers are like, okay, I'm coming in there, I'm going to work. If it breaks below that level, and I'm not talking about $317.95, you're going to get 2% below that level. That's going to be a big yellow flag for me. Again, looking at the technicals, this stock is, and it is very expensive on a fundamental basis. It's just too expensive. It's gotten too far ahead of its fundamentals. As good as its earnings are, as good as its prospects are, as good as its business is, I'm not worried about their business deteriorating. And people say, well, if their business is going to get better, the stock has to go up. Okay, well, Amazon went down 90% in the first couple of years of this century, and their earnings and revenues exploded to the upside. Now, that's an extreme because that was a dot-com bubble and it got ridiculously ahead of its fundamentals. But the point is, Amazon has been doing well fundamentally for 25 years, changed the world. Okay, it still had 24 corrections of 20 to 60%. And that includes the 90% crash it saw back then. So when stocks, because of froth and too much liquidity, get way ahead of themselves, they can still go down. And this one, which is obviously screaming so much in my mind, has nothing to do with fundamentals and actually nothing to do with technicals. The thing why it's on my radar screen so much is that their CEO sold half of his stock, $280 million worth of stock. And then people said, well, Washington State is about to go to in state 7% real estate capital gains tax. That's why he sold it. Okay, the stock has averaged a 33% gain every year for the last. It's average over the last 9 years. 33%. The worst year was up 12%. Okay, that was the worst year in the last 9 years. Okay, so if it goes up 12% next year, he's still making more money than he would be if he pays an extra 7% for the Washington State tax. Okay, he's not selling it because of the increase in tax. That's baloney. Okay, and again, if somebody who has $5 million worth of stock, and okay, that I'd worry about that. I can understand that. Okay, he's a lower level guy. I mean, we'd all love that $5 million worth of stock, so it's not too low level. But the point is, if you sell a certain amount because, hey, that's going to pay for my kid's college, that the difference of that could really have, for him, it's not, you don't sell. Again, if he had sold $5 million worth of stock, I said, okay, yeah, fine, whatever. What, he wants to buy a new house, or maybe it's $15 million. He wants to buy a house, a gazillion-dollar house right on the water. That's fine. But you don't sell half of your position unless you're worried about the fact that this stock is probably going to go down and stay below where it is right now for an extended period of time. So on a short-term basis, when we see this, it's probably not next week because the seasonals are good around Christmas time, Santa Claus rally and all that. We're looking at this, and it breaks below that level. We're going to load up on put options going out a week or two, because I think this stock will fall hard. And again, keep repeating the same terminology over time and again, but it is true. Stocks, great companies go down. They've been going down for a short period of time, and even for an intermediate period of time forever. It hasn't changed at all. Okay, now I don't know if at some point here, what time we got? Okay, good. We do want to go into some particular stocks for you guys that you might want to pick. But what I'm really just trying to convey here is, and talk about what we do on this chat room, is I'm talking about this stuff all day long, and why it's why it's helpful. So hopefully people can learn. And like I said, you wouldn't believe how often we get people showing different ideas and say, hey, I'm taking profits here, and they'll come out and say, I think this thing's got further to run, and somebody else will come on and say, well, I'm taking profits, and I'm like, fine, I'm not here to I'm a trader and a strategist, not a retail stockbroker who's an investor who's helping you form your portfolios and things. I'm helping you trade on this one bucket that I think can enhance your portfolio. So and people have, and of course different people have different levels of risk tolerance, and mine's probably a little higher than most. And however, though, I try to make sure that I keep that in mind. I don't go overboard. And sometimes I'll say, hey, listen, people, this would be a smart thing to do right here is to take profits. Or the smart thing to do is to take loss. You take the loss here. I'm going to stick with it a little bit longer because I have a little bit higher risk tolerance. But I say, no, for most people, the right idea here is to get out of the stock or get out of the put or call. But again, we're talking about this stuff all day long, every single day. I see if Rodrigo there, we want to talk about some individual stocks or how we want to play it now. But
yeah, let's go over some stocks and give it for about, I don't know, 15 minutes or so. You got 15 minutes?
Yeah.
Okay. All right. So guys, go ahead. Well, before anything, Matt, just have to make something here really quick. 1 second. We have to give somebody very important here a good welcome to the family, right? To the chat room. Obviously, we have a new member here. I'm not gonna go over the name and everything, but I do want to give you a shout out. Welcome to the family, XTW54. Welcome to the family. Welcome to the chat room.
Thanks for being here. I think you'll enjoy it. You'll find it very profitable, I think, and not only that, very, very educational and enlightening. So I think it's going to be a good. It's a good, especially as we move into next year. It's going to be an unbelievable. It's going to be an unbelievable year next year, and there's going to be some people who are crying at this time next year, and I think we're going to be smiling very nicely.
All right. Really quick, I'm just going to get these questions out of the way. Matt is there throughout the day. He's talking about trades and answering your questions, things like that. Yes, it is $12.97 for the year plus the laptop. Once it renews next year, you will keep the same price, even if it goes back up to $6,000. This does include the chat room. It does include the laptop. It includes the sessions that you're going to have every week with Chief Market Strategist Matt Maley, where you can, either ask a question or go over the market. You guys, are in the chat room with Matt all day. So obviously, you guys work together on that. And any other questions that you have for Matt also included. We are going to be putting out a new upgraded chat. That's probably going to be done by mid and January, where you're going to have a bunch of new features, a bunch of new tools there. You don't have to pay anything for it. We're just improving our services here for you guys. So Kowalski, send me an email. Okay. All right. So guys, go ahead and throw those tickers. Matt is kind enough to stay with us and review this with you guys. So let's go ahead and get some names, some tickers on the chat. Let's go. SQ. Let's go from Robbie Square. Look at Matt work. Getting ready.
There it goes. Okay, hold on. Oh, there we go. Sorry. For some reason I couldn't pull it up there for a second. Froze on me, but it's all right. Okay, Square. Okay, here we go. This one, look at this one. This is, obviously has had a really tough time. And one of the things that's hard, of course, is when a stock has only been public for, oh, wait. Okay, see, well, look at this thing. Look at that, how bad this was when it broke. See this line? I mean, look, you can see how 200 was such a key level, and it just got absolutely smoked when it got hit. Okay, when it broke below that level. But now it's getting oversold. Now see how this RSI is getting really oversold? That's the relative strength index. What I'm going to do though here is I'm also going to look at the weekly. Okay. See this? Look, I'm going to go back to. Okay. Oops. Okay, there we go. Okay. It's only been this oversold once. Okay, once on the weekly chart. Okay, so this one's looking like, so this is starting finally to look. Nobody likes this stock. Okay, and so this is on a short-term basis anyway. And so it's something that's really going to look. Let's look at the short interest here. I'm sorry. Okay, I want to look at this again. 1.6. Look at the short interest on this stock. Okay, very, very high. Okay, it's been high for a while. But when this stock turns, there is going to be a short squeeze. And meme stocks or not, even if the meme stock thing starts to fade, this stock's going to get squeezed. Okay, now look at them right now here. The fact, it looked like it's trying to form a base. This one was just I don't like the fact that this made such a sharp bounce. Okay, people say, oh gosh, this must be it. But see right here, it made a nice bounce, but it was a gap opening and it failed. This one finally it kind of settled around here on a lower level for a couple of days. So it's trying to build a base. It did that a couple other times. It didn't work, but this one, since its weekly RSI is so incredibly oversold, I'm back to the daily one now. Let's go back to that weekly RSI. We want to be looking at this stock now. I'm looking at the trend line here. Again, I'm sorry, I'm kind of stammering here, but because there's so many things that look good on this. On it. Okay, now look at this here. Look at this is the MACD chart. Remember we talked about that. Now, MACD charts, you want to see a compelling cross. We saw right here, it made it wasn't a very compelling cross, right? Or in that area. It was just a quick head fake. This one, when it went to the upside, but still even this one saw a nice rally. Look at this compelling one. Gosh darn, I gotta get this stuff out of the way. So it's so many lines that are making it hard to read the chart, but let me get this out of here. Okay, cool. Okay, good. But see how we got, there's a nice cross there, the stock rally. There's a positive cross. Look how long the stock rallied. Okay, they tried to make a cross, but didn't really work. Here it was a positive cross. Look how much the stock rallied. Okay, there's a better rally here, but now the stock has only been this oversold one other time. We're getting very close to a positive cross. So I am looking at this stock and I'm thinking the last 2 days, the high of the stock has been basically $172 each of the last 2 days. It gets above 172, I'm going to start buying a little bit of that stock. And once it moves higher and it gets above this level, we finally make a higher high, which hasn't made since God was a child. Okay, that level is 177. Then I'm going to buy calls. Well, why wouldn't you buy calls here if you're going to buy them at 177? Why wouldn't you buy them right now? Well, because I don't know for sure if this positive MACD cross is going to be a real one or if it's going to be the head fake that we saw over here. Okay, we want to make sure, we want to get confirmation. That's the whole thing. Is it lick your finger, stick it in the air? That's guessing. We're trying to make educated guesses, not educated guesses, they're educated decisions. All right, not just guesses. Geez, I hope I'm right that I got this about him. And so you leave a little money on the table. Now, sometimes things get so extremely oversold or so extremely overbought. Like remember that thing where I talked about with Viacom? It got so ridiculously overbought. We were waiting for any confirmation. Let's just make the bet and go all in. There's no problem there. But this one, even though it's very oversold, it's not crazy historically oversold. So we're still going to wait for that confirmation. But boy, this stock is one that's finally seen some potential. But we want to be a little careful about getting in front of it too quickly, because if we do, see, it's trying to break up out of that new trend line. But see, it's done it a couple of times. Each one of those was a head fake. So we got to make sure it's not a head fake this time. But again, going back to that RSI, that weekly RSI, this is the second most overbought it's ever been. So it's much more likely that this one is going to work this time, that it didn't work here and didn't work here. Okay, so that's the one we're looking at for. Watch those levels, 172 and 177. 172 to nibble on the common stock, 172 to get more aggressive, 179 to get more aggressive, and you do that. I think you can make a lot of money because again, once it goes, the short's going to squeeze this thing and it's going to rocket higher, just like it did here. And again, look at this. When a couple of times it got squeezed. Hello. Okay, suddenly, and when you make 20%, if the stock goes up 10% in a few days, guess what the options do? They go multiple 100%.
Okay, and then we have from our good friend here, Anne Lulu.
Lulu, I'm sorry. Gosh, thing froze up again here. I'll take a second. Lululemon, I'll tell you, I was in Lululemon, and it's funny because you do hear these people are saying that they worry that this thing is going to that they're going to have some more competition, but I've been hearing that for a long time. So fundamentally, the stock has come down. Look again. Look, all I have to do, look right away. I look at this, go, look how oversold the stock is. Okay, and again, it's not crazy. But it's look what it did the last time it got this oversold. Okay, it saw a very nice rally. So longer term, I like this anyway, on a fundamental basis. But on the options, this could be one we're looking at, because the other thing that we're looking at, let's take this away, try to make this chart a little less messy. There's so many different things here, but look at this. See on the chart? I'm going to go back a little bit further. 2018. Let's see how much that changes. Okay, now see how the 200-day moving average, when it broke it this time, it kind of held it a bunch of times. It finally broke it and got killed. But then when it finally broke back above it, it just took off. When it finally broke below it, got hurt. Couldn't break above it. It got a little above it. Again, remember, I say you always have to get more than just a slight break above or below a key line. That was a head fake. It got hit again. This time it looked like it was going to be another head fake. Then when it confirmed to the upside, off it went. Okay, so this old resistance becomes new support. We only did slightly below it. It looked like it was going to crash below it, but now it's regained that 200-day moving average. That is bullish. Let's look how oversold it got there. It got the same oversold there. Look what it did afterwards. Look what it did after there. This one was deep. Now this one got more oversold, but of course that's when the entire global economy was shutting down. So I'm not worried about it getting that oversold before it bounces. This stock looks really compelling to me. Now let's look at the MACD chart. Okay, there's another one I can look at, is the Bollinger Bands chart. Again, this talks about an issue when a stock gets, on a really short-term basis, if a stock gets more than 2 standard deviations from its 20-day, not 200-day, 20-day moving average, okay, that can tell you that it's becoming really oversold. Now, see how it got down here? It's hard to see with this chart because there's a lot of things going on here, but see if I can grow this a little bit so you can see it better. But see here, this green line, again, green because it got right, now this is a couple days ago, it got right down below that line, okay? And that was a great buying opportunity. See when it got down to that line here, great buying opportunity. When it got down the line there, great buying opportunity. There, great buying opportunity. There, great buying opportunity. There, good buying opportunity. There, good buying opportunity. There, great buying opportunity. Okay, so this was an unbelievably great buying opportunity. Now that it's back above its 200-day moving average, it's still got plenty to go. Let's look at the short. I don't think the short interest is real high on this one. But again, these are the things I'm looking at, all sorts of different things. What to get confirmation. Now the short interest isn't too crazy, so it may not get squeezed that much, but it doesn't matter. It's a great company with a great product. Yeah, so the short interest is actually rather low. So we're not going to get the same kind of movement that we did with that we're likely to get with Square. But it doesn't mean it can't see a very, very strong move. And again, I'll just bring it back up again, the same kind of way. Again, that overday. I just love the fact that it's bouncing off. And again, it bounces a little bit below that 200-day. That's not a problem because it regained it rather quickly. And the fact that it's regained it rather quickly. Oh, did I do the MACD? Let me just do the MACD chart. I'm sure that's moving back up. Now this hasn't made it yet, but boy, but again, look when the MACD had a positive cross there. Look what the stock did. Positive cross there. Well, that was a gap opening. But look at the positive cross there. Stock rallied really strongly. Again, you just go back and back. Here, we're not quite there yet. So if you really want confirmation, I would wait for that. But so I'm buying this stock now in the common stock. I'm waiting for a positive MACD cross to buy the options, and probably go out a week and a half, 2 weeks, and I'll buy at the money and make some nice money on this one. This one looks really good. Again, I worry about the overall market, so be careful. But again, the stocks that are washed out. I mean, look what AT&T did. AT&T was early on Monday. The market got absolutely crushed, and AT&T, which has an 8% dividend yield, and it's a boring stock, But I mean, look what this stock has done this week. Like, you know, the market, this is Monday, or say, this is what when the stock market was getting clobbered on Friday and Monday, this is what AT&T was doing. So when stocks get ridiculously oversold, they can go against what the market's doing. And that's kind of what Lululemon's looking at right now. And again, look how oversold AT&T was on its weekly chart. I mean, unbelievable. So it can absolutely move against, even if the market's getting hit, even if the market's getting hit hard, stocks can still bounce. I will say though, having said that, if the stock market goes through a long correction, most stocks will go down. I mean, there'll be some good defensive plays that'll do okay, but Apple's going to go down. I mean, Apple's a great company, great stock. People find it as a good defensive play. If the stock market goes down 10%, there's no way Apple's going to go going up. Okay, it's going to come down. That creates opportunities. So I don't want to overstate that, but on short-term plays, when stocks get washed out, we can still make a nice play on that. So you buy the common, then you can trade around with options, and Lululemon looks like a great opportunity. So we have two now already. So Square and Lulu that look like great opportunities on the long side, on the buy side.
All right, and then we have Pinterest from Kolsiki. Shout out to him. He's a member.
Okay. Oh, one thing just before we wrap things up is just that again, tomorrow, those who new join tomorrow, it's the day before Christmas Eve, the day before the market closes, the day before a long weekend. There's probably not going to be a lot to talk about. So don't be disappointed when you come on and say there's not going to be a lot going on. And even next week, even though it's a holiday week, we're going to be in there, I think, hopefully doing a lot, because I think we'll still be a volatile week. But I'll be there pretty much all day, most every day. So I might take a half a day off if things are quiet, but we'll just have to see. But again, if it kind of don't be disappointed tomorrow. That everything's going to die down and it's going to be very, very quiet. So we just be guessing it, and most of the stuff is trying to do some trades tomorrow. But anyway, so let's go back to this Pinterest. You can see obviously the stocks had a real tough time, but it's obviously getting oversold. The problem is it was oversold here and it kept going lower. So let's look at it on a longer term basis. Okay, very, very oversold, but not crazy so. Now I don't know what you guys think of Pinterest fundamentally. I talk to I try to talk to younger people, and they're not too keen on it. But I do like the fact that it's trying to form a base here. Even though it was a tight range here, it was still going down. Okay, same thing here, still going down. Even though 3 days up, now we're 4. I actually like the fact that it didn't go up like this, because that's just short covering, right? This is one where it's finally starting to build a base. Now, what we do here, if you like the stock and want to take a chance on it, that's great, because what you can use is the recent lows, which is basically 34, a couple of days in a row is right around that, 35, I'm sorry. Oops, I'm looking at the wrong day. $34. So that's been the low for the last couple of days. You break below 34, that's your stop level. You're not using a 10% stop level. You're using 34. Drops below 34, again, if it's 33.98, that's fine. But I mean, it drops much below 34. I'm out of the stock. You have a very small loss. And wait for the next entry point. For the options here, I'm looking at, it's just something you can do. What we use is funny, because one of the things we use that's worked really well for us is I call lottery tickets. And now, a lot of these stocks, like I'm sure Pinterest does, I'll just make sure here. Pinterest has options that expire tomorrow, I'm sure. Yes, so they have options that that expire tomorrow. Open interest is okay. Okay. But the reason why I mention it is that what we do is we'll go in on a stock that has 1 or 2 days left before expiration, an option on a stock. And we call it a lottery ticket, because there's very little time value in it. So the people who are making the markets don't charge you a lot. If you're trying for a market, I'm making a market in an option that expires 3 months from now. Well, there's a lot of risk for that person who's writing the option, who's selling the option, because anything can happen over a 3-month period of time. But if it's just 2 days, like, can a stock really move that much in 2 days? Well, sometimes they can, and that's what we try to take advantage of. And so we buy an at-the-money option. You don't have to pay much time premium. And if the stock sees an outsized move, and you can see how in Pinterest it's seen some big outsized moves, not so much lately, but it has over the years, over the last year, you could see an outsized move. So what do? You go out, you buy an at-the-money. In this case, it'd be the $38 call option that expires tomorrow. Now, This is a little bit dicier because you're buying it on the day. Usually when you buy it on Thursday, it's because you still have one more day. I don't like buying it the same day. So this might be a better one that we look at late next week. But you can see that when we do it for these individual stocks, it's later in the week because that's when you're getting really close to the expiration date. But we refer to it as a lottery ticket because what do you do with a lottery ticket? Do you go in and say, oh my gosh, I really think I can make a lot of money in Apple, so I'm going to spend $1,000 buying Apple stock. Great, because you like it. You're going to go in and buy $1,000 on a lottery ticket? I mean, again, some people, I guess they do, but your chances of winning that are very, very low. Now, the chances, we call them lottery tickets, the chances of you making money on a stock that's very, very oversold and just before an expiration date is much higher than a lottery ticket. But the point is, it's still very low. So we don't spend a lot on it. We don't go and say, I'm going to put 5% of my portfolio in there. No, we put in whatever you put in money that you don't mind losing. It's like, if it's $50, $100, maybe some people, maybe it's a couple thousand. That's a lot of money, but if it's $100, well, okay, you go in and the stock takes off, you make $500. Okay. And if you don't mind losing the 100, if you only have 50, okay, let's say it's just $50. You really don't mind losing that. You go up to, suddenly you make $250. Now you can take that and say, okay, now I've got a real one that I really believe in. I really think it's going to work. And so you don't make too many. It's funny. We've been more successful than you think in these lottery tickets. And it gives you a little kitty to make a money kitty, as we used to say in the I don't know if the young people use that term now, but we have an extra kitty where you just kind of take the money out of it, and it's like, oh gosh, free money, we got this, and suddenly we have more money than we thought. And then when we wanted to make that call on Tesla or Apple or Microsoft, we suddenly, instead of making a $300 investment, now we're making a $500 investment, and it's one we really believe in that's going to make us some nice money. And of course, you've made more money. But on the Pinterest one, if you want to look at it tomorrow and it opens and you look at that $38 call, again, I don't like it buying it the day of the expiration, but a lot of times the day before it can work out really well. But this one does have some upside potential. But I'd really like to see, because it's had so many problems and it's not as oversold as some of the others, it's MACD again. Look at how many head fakes we've had in the MACD chart. You really need to see it. I'd almost rather see that stock get up above 40 before I'd really believe the thing is going to run. And let's just look at one more thing. Short interest is, I'm surprised it's that low. Let's see here. Yeah, well, it's not crazy low, but they could get squeezed too. But this is one I want to see a little bit. My dad's from Missouri, 92 years old, about to turn 92. It's the show me state. This one's I'm show me. I have more confidence if it got above $40. And that's the other thing too, is people say, what? Well, if it gets above 40, why wouldn't you buy it at 38? I was like, well, because I'll have more confidence at that level. It's I'm not guessing anymore. I'm more confident. I don't mind missing $2 if it's going to get me $10.
Okay, great analysis there. Absolutely. Well, Matt, it's been a great session here. I've learned a lot here, as I always do when we do these. What are some closing remarks here, not just on the market, but why the folks here should go ahead and join the chat room where you're pretty much whipping out trades and trading with them?
Yeah, the whole idea here is that for me, especially at this time, it happens to be like we started doing this chat room. I didn't, I was worried at the time. This is not why we did the chat room, but I just see this as an unbelievable opportunity, because when you go back in history, every time the Fed changed policy like this, it has an impact. It has a negative impact on the market. Sometimes it takes a little while, but we've already been tightening for a little while, and the odds that we're going to face some headwinds are very high. And I think that when you're talking, and this is not, we don't have 100,000 people on this website, on this chat room, where you got some guy who says he's an individual investor and he's really working for a hedge fund. He's trying to get people to buy a stock so he can pump it and dump it. All right, we're talking about things on a regular basis, on good ideas, with good reasons behind it. We're not just guessing, and we're bouncing it off each other all day long. But more importantly, we're learning. That's one of the things I constantly hear from our subscribers right now, are just saying, our guys in the chat room, it's like, I'm learning so much every single day. A person say today, they were a little confused on one issue. It was very, very simple. But just because it's simple doesn't mean people know it. When you walk in and you say, okay, how do I play Go Fish in cards? How do I play? That's the easiest game in the world. But if you've never heard of it, it takes you at least a few minutes to learn it, right? And that's the one thing I constantly say, and we said it today 2 different times, like big capital letters. There's no such thing as a dumb question. There's a stupid question. Nothing is stupid. Don't be afraid. Nobody's going to call you out on it. We have all sorts of varying degrees of people with experience, and there's people with a lot of experience in one area who don't have any in this other area, and we're constantly helping each other, teach each other how to do this more active trading, so we can do it in an educational way and in a way where we're not just guessing. It worked really well, in the first 6 months of this year, even first 8 months this year, because the market was going straight up. It's going to be a lot harder, but if you know what you're doing and have people to help you guide, not just me, but all these other people who are throwing out their opinions on things, and at least help you look at things in a different way. It's like, this looks really good. So many people say, oh, the stock's gone up 3 days in a row. It must be going higher, right? And I'm like, well, actually, no. And this is why. If anything, I think it's going down. And so we kind of trade around these things, and it's worked out really well. But the point is that I think we're at a key turning point in the market. The good thing is that the bear market, it was a bear market or corrections, they are a lot shorter in time frame, but they can be very painful. And I just really, really strongly believe that we're going to be heading into this situation where it won't go down. There'll be some sharp rallies as we go through this, and we want to be able to take advantage of it on both sides. But now we have the tools. The individuals have the tools that we didn't have in the past, and I think we could really do it. And again, we're talking all day long, every day, and there's always time when you come in and you can ask a question. It's not a market letter that comes out once a month and you don't know what the hell's going on, and then suddenly something big happens and you might get an interim report, you might not. We're here all day. I mean, all day. So, I'm very passionate about the markets, and I love this stuff, and I hope that comes across. But the whole idea here is to help people make money and maximize their returns. And I think next year is going to be a year where some people are going to have a rough time in the markets. And I think the way we do things, the way we look at them, in a very unique way, combining fundamentals, technicals, positioning, etc. We're going to profit in a big way. So thanks everybody for coming on today. And again, tomorrow will be a very quiet day. And next week, we'll see what happens, what kind of week it could be. It could be a quiet one, it could be a busy one. But next year, we start off the first year, it's going to be a big year. And if the situation changes, I'll change with it. When the facts change, I have to change my opinions. And I will certainly do that. But right now, we're looking at something that I think, and again, when you have a guy like the CEO of Microsoft selling half his portfolio, and this is the biggest year ever for insider selling. All right, and like I showed, smart people sell at the top, and that's what they've been doing this year. And the insiders, whether they're smart or not, they're on the inside, so they know what's going on, and they know their stocks are ahead of themselves, even if their companies are doing fine, and they want to take advantage of it. And we want to be able to take advantage of it as well. So good luck with everybody. I hope everybody has a great holiday. And for those who joined, thanks for joining. And again, tomorrow we'll talk, but it'll be pretty light. But next week we'll get going in a more aggressive way, and then the week after that we'll really be going. We'll be flying.
All right, Matt. Thanks for being here. Appreciate it, man. Thanks a lot for everything you do here for the retail community.
Thanks, Rodrigo. You have a great holiday, buddy. We'll talk to you real soon.
You too, man. Great doing this with you. And I'll stay here answering questions about the subscription for a little while. I'm going to show you guys the chat room itself so you can take a look at it. 1 second. All right, there you go. That's the chat room. We are releasing, like I said, the new upgrade about mid to end January next year, like next month, pretty much. So this is where you'll be able to see all the trade ideas, all the conversations with Matt, entries, exits, ticker symbols. You can at him as well. So that way, if you have a specific question or about your ticker or strategies, whatever it is. Yes, this is for the year. Correct. It's not monthly. This is yearly. Correct. If you are in options, yes, absolutely. That's what we were talking about here. Matt does plenty of options. That's what he loves to do. So I'm going to drop my contact information here, guys. If you have any questions, feel free to reach out and I'll be more than happy to help you guys. But just want to give you guys a shout out, a welcome for those that joined, and also for all you guys that are here, for putting the time and effort into becoming a more responsible, a more educated trader, investor, whatever you are. It's definitely important to do this. So us doing it, we love doing it, and we love that you guys are here. So guys, I'll drop the contact and just reach out if you have any questions. Thanks a lot. Happy holidays, and we'll see you guys on the next time.
But sometimes people see an R pit that ends up in here. That's not head and shoulders pattern. Okay, this is my triangles. A break of the flat line on an ascending triangle. The flat line is the upper line. On the descending triangle for a few days. And when a lot of people buy it all at once, especially when it's an out of the money call option, because a lot of times it's out of the money, they're like, these were fabulous. However, they didn't raise forward guidance. The consensus stayed the same for both the fourth quarter estimates and for 2022 estimates. Okay, now I want to zoom in on this. So first of all, look at this RSI. This isn't oversold at all. I mean, it's barely the neutral on the neckline of this important pattern. This is one of the most compelling patterns in technical analysis. Not only are some of those buyers getting out, people are selling. And it's a clear indication. So the thing is, though, today, you want to use very
Bye.